Hey everybody, it's Brian Shannon from alphatrends.net. Today's Friday, the 26th of August, 2016. Let's look at the closing numbers and then review the charts to see where we've come from and where we have the potential to go. The S&P 500 lost a little bit of ground this week, down a half of a percentage point. Same for the NASDAQ, but the Russell and the semiconductors were up a little bit here. Biotechs were the big move. There was news there. And then oil lost ground as well. So let's take a look at the charts here and make sense of this. We're still in a longer term uptrend. After breaking multiple year resistance a couple months ago, we've maintained above that prior level of resistance, and the longer term trend will still be given the benefit of the doubt as long as we remain above there. On the daily time frame, we came down a little bit below some support in here, and what we're going to do is drill down actually to a 30-minute time frame, because what we had seen was this band of support that we had been wanting to hold. It was violated and we came down through it, but right back up into that prior level of support. So what we have here might be similar actually to this breakdown that we saw. That is, we have to be aware that the bigger picture is still in an uptrend. Now, we have multiple time frames to analyze the market. It's up to you to decide which one is right for you. If you're a longer term investor, you look at this as a pullback and say we're still in this primary uptrend. On a daily time frame, we're still above a rising 50-day moving average. That tells me that the pullbacks are generally just pullbacks within a primary uptrend. Oftentimes we see the 20-day tested and then down to the 50-day moving average. And if we were to fall down to the 50-day moving average, that would only bring us down to this prior little pullback low, and it's really not that far away. But if you take a look at what might be the justification for that, if you look at the two failed breakouts that we saw in the last couple weeks up near that 219.5 level, measured down to about 217.25, could be what you would call a double top area, that breaking that would then lead to a move of 2.25 points lower. So that would bring the market down to about 215 or so, which is pretty close to this prior level, and it's pretty close to the 50-day moving average. It's also pretty close to the volume weighted average price from the Brexit low. So that's certainly a possibility. And right now, with the market below the declining 5-day moving average, the intermediate term trend tells us not to trust this little bounce at the end of the day, but instead to look at it and say we have an intermediate term breakdown. It may in fact end up being another failed breakdown like we saw over here, trapping in short sellers and then squeezing them, or perhaps we continue to move lower. We simply don't know. We have the ability to look into a crystal ball, but the crystal balls are broken. In fact, nobody knows what is going to happen next, but we try to look at it and say, what is the one thing that we do have control over? And then that's risk management. And knowing that if it breaks below that level, maybe that's where you want to be out. It's up to you to decide which time frame to engage the market on. I think that if this market does fail, the likely scenario would be something like this, and then down towards that 215 level. The other scenario is that it rallies back up towards this area, kind of turns sideways, and we see more consolidation before the next move higher. Certainly the longer term time frame would tell us that it's more likely to continue higher. Right now, it's simply not that clear, but the intermediate term trend does point lower. Therefore, wait a little bit. There's nothing wrong with having cash as a position, and not every stock is going to follow the S&P 500. You have to manage risk based on the individual trade that you're trading. If you're trading the S&P 500, then the S&P 500 should be the main thing you look at. If you're looking at trading Facebook, you should be looking at Facebook primarily. The NASDAQ was, as we said, lost a little bit of ground here as well, down 41 basis points. And we're still kind of in this bigger range that we've seen. We're closing right along that rising 20-day moving average, and this market has had a heck of a rally. In fact, if it were to pull back to the volume weighted average price, that would, since the Brexit low, that would bring us down towards that 50-day moving average way down here. I think that's a little far-fetched to think that we're going to get a move of that magnitude to the downside, because the primary trend, of course, is higher. So what do we see here on the intermediate term time frame? Let's look at a 30-minute that chart. This has been the lower end of that band of support. The higher end of band of resistance has been up here. Similarly, if we were to take a look at this as a double top, then we would say basically we'll call it 118 with this as the important level. So breaking below 116.50, in other words, 1.5 points, we would subtract 1.5 points from 116.50 rather, and then we would look for a move down towards 115 would be that 1.5 point move. So that's certainly, I think, possible on this move right now that we're seeing. However, we have to take a look again and say, we're guilty till proven innocent in my mind while we have lower highs and lower lows below a declining 5-day moving average. For this market to get back to a more positive note, it needs to get back above and hold above not only that 5-day moving average, but the 117.50 level. So right now, again, we have a lot of confusion in terms of different time frames giving us mixed messages, but with the longer term picture still in an uptrend, we give the benefit of the doubt to the buyers for the long term and look at this as a period of indecision, a battle here with bigger volatility, and bigger volatility often does precede turning points, so we take it seriously. We simply do not know if this is just going to be a shakeout. The last little shakeout occurred over here. For the Russell 2000, we've got this uptrend line that from the beginning of August that it was broken, and we were talking the last couple weeks about this pattern of higher highs and higher lows with this rising 5-day moving average. Well, that was broken today. That longer term pattern we'd seen now. We saw a lower high here and then this lower low. Now the 5-day moving average is flattened out. We're at the volume weighted average price from this last shakeout. So I think that it's early to be bearish on the Russell 2000. Breaking a trend line doesn't mean it will continue lower. It simply means there's a slowdown in the rate of ascent. It does not mean reversal. I think that next week, if you see it, maybe rally up a little bit towards this 5-day moving average and then break down through 122.25, that you would give the benefit of the doubt on the intermediate term to the sellers, and then a stop would go somewhere up in here, wherever that next lower high would be. But again, on the daily time frame, what do we see? We see a bigger picture uptrend, and that's on the weekly time frame as well. We are quite extended, but that does not mean it cannot continue to move higher. And right now, to get back to, well, we're still giving the benefit of the doubt to the buyers here until it breaks below 122.5. Semiconductors were up 28 cents today, and again, they were positive on the week as well. They were up 0.5 percentage point. Year to date, they're up 24% right now. So clearly, a lot of shorts have been getting hurt in here. But if you look at the direction of the 5-day moving average and the fact that we have not seen it flatten out and then make a pattern of lower highs and lower lows, the buyers are still in control. We came down and tested this little higher high right here, and what we're seeing is a nice stair step higher in the market. Now that's kind of gotten a little messed up in here. I don't view it as a negative thing until we get below and hold below 65.5. Breaking below 65.5 and then holding there for more than a half hour or so, I think you would probably want to get short for an intermediate term trade within, of course, this primary uptrend. We're still in a primary uptrend. We haven't even come down and tested that 20-day moving average. That's how strong this market has been. But I think that breaking this support would lead to at least a test of that 65 level. And again, the volume weighted average price from the last little shakeout low would bring us down towards that 65 level as well. So I think that for the semiconductors, you've got to be a little bit cautious because of the amount of energy they've expended to getting where they are. And where does it have the potential to go? Well, we're up at all-time highs, so there is no reasonable source of supply from people who are, looking to get out break even. There's no overhanging supply, that is, from people who are in a losing position. It's just natural profit taking. And when do they get nervous? Well, maybe below 65.5, they start to get a little bit nervous, and then we would expect it to drop down towards 65, and then evaluate how it holds in that area, if it holds in that area, or if it continues to decline from there. It's possible that we could see something like this and then break down and continue lower and get a bigger retracement. That is always the possibility. That's why we don't sell short in uptrends and we don't buy on pullbacks. We wait for evidence that the sellers have gained control. There's no evidence of that in the semiconductors. And similarly, when it begins to pull back, we're not going to just buy blindly because we're at a 20-day moving average or at a retracement level. We're going to wait for actual evidence on the intraday time frames, and that's what I talk about each and every day for subscribers are those key levels. The biotechs coming into this week, I was bullish on these. I was, as I told subscribers, getting back above and holding above this level looked like the place to be a buyer, and we were talking about buying right in here because one, we didn't want to chase a gap, and then it pulled back this little band of resistance, held as support, it showed strength here, and we got involved that day and set our stop underneath here. And this is where we got out because we had seen that it had that big, that initial strength. It got up to daily R2 and we took a third of it off and then get stopped out of the balance down here before this large decline. So again, what time frame are you involved in? If you're an intermediate term trader, you want to look at it and say this bigger band of prior resistance in here that's been in place for most of the year was broken. It seemed to be holding as support, but it broke back down. Now these biotechs are pretty much dead money. If you're going to buy a biotech, don't buy the beaten down ones. Look at stocks like Amgen. Amgen got taken down because the rest of the biotechs did, but Amgen has been a stock which has been in a phenomenal uptrend and consolidating sideways through time here over the last couple of years, and this is one of the stronger ones. You don't just buy it though blindly. You wait for it to get back up above what is right now the potential for resistance at this prior support. So it's about making the smart decisions in the right stocks. The bonds lost a little bit of ground here today. Obviously, that brings rates higher. But we still have a rising 50-day moving average, and the benefit of the doubt for the bonds should continue to go to the buyers, I think, until we break below this level. If we break below there, then it's a different story for the bonds. Alibaba is starting to, it pulled back a little bit this week. As we know, it had broken beyond that volume weighted average price since the IPO and really screamed higher from there. Now, when we look at, since the earnings, the gap based on the earnings, the volume weighted average price is up in here. And this is where I think the buyers will regain control next week if it can get back up above that level. Shares of Apple lost a little bit of ground, and right now they're holding right along that volume weighted average price since the earnings report. So as I mentioned to subscribers, I think that the proper place to exit trades was right under here as it made a lower low below that declining 5-day moving average. If it fails to hold in here, then perhaps there's a deeper pullback, and that's, Apple's one stock. It's not the magical stock. It's one stock amongst many, but it does have a declining 5-day moving average right now. I would not buy here because it's the volume weighted average price from the earnings, but I would certainly take note of it. And then, if you're bullish on the stock, wait for the evidence, wait for it to start to turn sideways, doing something like this, and then holding above the 5-day moving average, seeing the 5-day moving average flatten out, and then buying strength above it with a stop underneath that most recent relevant higher low. That's the scenario that you want to buy Apple under. You don't want to just buy blindly into pullbacks because it might be the pullback that just keeps pulling back, like we saw at the end of last year that broke through moving averages and perceived levels of support and all that. The next week I'd say keep an eye on Cerner. This one has the potential to maybe to get moving back higher once again. Twitter, by the way, is at an interesting level. The volume weighted average price since earnings, you can see, is right around in this area. So in fact, if we take a look at look at a 30-minute time frame for that, you can see that the volume weighted average price since that last earnings report where it gapped lower and then recovered is right in this area. We also have just below us at about $17.80 a 61.8% retracement of the low from the earnings to the recent high. So this looks like a potential area for support. And then on the daily time frame, we've also got that 50-day moving average right down here at that 61.8% level. Longer term, however, again, if they don't scare you out, they'll typically wear you out. You still have a declining 200-day moving average. So there's really no big hurry that I can see to own Twitter. But if you're, if you like trading Twitter, then of course you want to look for something that might look even, maybe even comes down a little bit further, gets back up like this. And then once it gets back above some resistance, and then you can set a stop, based on price structure, just below a higher low, then taking a position over here and knowing what your stop is, that's what that's probability trading. That's not just taking a blind bet outright. Hey, I think it's a good value or whatever. The market doesn't care what you think. It doesn't care what I think. So we wait for price confirmation. We anticipate all the potential scenarios. We're aware of key levels that are likely to become battle zones, like the volume weighted average price since the earnings report, like the retracement, and like the 50% 50-day moving average. But we wait for price confirmation before we put our hard-earned money at risk. It's simply stupid to be the buyer, up here. Who buys after it's gone from 16, 17 to 22? It doesn't make sense. So be smart. That's what having an approach based on market structure is all about. This week we had some great trades in Alpha Trends. We had BEAV, we got involved in that one over here, got out initially on that first run of a third of it, and then got out of the balance up over in here. CLGX we got involved in right here. We're still long a third of our position. DHI was one that we got involved in and took a very small loss very quickly. These home builders looked like they were getting ready to turn higher. Look at the charts of not only this DHI but PHM and KBH, and you can see that they all look kind of the same. Marvell was another one we closed out nicely this week, and Nectar was one that we closed out. We got involved on strength right in here, and then we got out right there before all that mess in the biotechs. So learn to manage risk based on each individual trade that you're trading and have a consistent methodology that fits your approach and your time frame.